Hey everybody, Chuck Barone, Monday, August 29th, 2022. A new week and new crazy to talk about in these markets. Man, I gotta tell you, when you get a little older, you think you've seen everything, and then you realize, oh my God, I really thought I've seen it all, but I haven't seen jack. This is just crazy times. Some really interesting stuff happening this week we need to talk about. Before I start, though, I just want to thank everybody, as always, for their support for the show and the videos. We really appreciate you guys more than you can know. In the markets today, well, it was kind of a pretty bleak day following up Friday's bleak day. Not as bad as Friday, but stocks down today across the board. Stock market not reacting well to the reality of what's happening with interest rates. The idea that interest rates could stay elevated for some time. I think what we're looking at here, guys, when we talked about this on an earlier video, the era of easy money, this era of cheap, easy money is over. I think we're going to get back to more normal times where you're going to be able to earn a little bit of a return in your savings account in money markets. You're going to be paying more to borrow money, which is probably not great for the overall economy, but certainly great for the people involved in that economy who are not going to take on as much debt, and ideally will learn ultimately to live without it, or with it at very minimum monthly payoff type of levels. Anyway, stocks not digging it. Down today, following up Friday's down day. I think that, unless there's some big earnings news or some very dovish language coming out of the Fed, I think stocks are going to be in for a little bit of a correction here. Bond market also down today. The 10-year sitting at 3.11. I know the stock market is not liking that. I still think it's got quite a ways to go. They talk about to eliminate inflation, the overnight rate needs to be actually higher than the rate of inflation. Now, depending on which rate of inflation you use, whether it's the CPI at 8.5 or this the Fed's preferred way much lower, the PCE index, the personal consumption expenditures, which is about 6.5, with rates sitting at 2 and basically 2 and 2.35, there's still quite a bit of lag there between even the much lower inflation rate at 6.5 and 2.3, right? So the Fed is going to continue to raise rates until it gets this inflation stamped down. That was the message Friday, the message they carried through the weekend, even though we had our Congress critters and these yo-yos from the government out there screaming bloody murder about it, how it's going to cause a recession. These Congress people obviously are not economics majors, right? But anyway, the bond market not reacting well as either. But the gap between the 10-year, or the 2-year, and the 10-year. The 2-year sitting up here at 3.47, 10-year 3.11. So the inversion is kind of still there, kind of been narrowing between 35 and 45 basis points. Looks weird on the yield curve, guys. It just doesn't look right. The dollar, basically a flat day today, still super strong on the index, though, at 108.81. The strong dollar actually is probably saving the Federal Reserve a little bit of grief because, all commodities are priced in dollars, and a strong dollar helps us with keeping some costs down, even though they're highly elevated. It would be worse if we were the euro or some other currency. So the dollar is strong against the world's currencies. Again, though, with the caveat, not so strong in the supermarket. Every day my wife shops or I go there to pick up something or just some small insult of what they're charging and what you're getting for your money at the store these days. The metals with a strong dollar having a small down day today. Gold at $1,738 per ounce. Silver at $18.86 per ounce. I was liking the fact that silver got back up above $19 so quickly. Hopefully, with maybe a little bit of relaxation in the dollar, silver's going to get that 19 again. But if not, it's going to be the buying opportunity we've been looking for you silver guys out there. The oil market, oil was up today, $96.50 per barrel for West Texas Intermediate. Natural gas, $9.37 for their million British thermal units. energy that everybody keeps talking about knocking the price of energy down for this election. Well, these prices are not knockdown prices, guys. If oil was 40 or 50 a barrel, okay, that'd be knocking it down. Natural gas has tripled. This price here is just outrageous for natural gas. So I want to see this election knocking down of oil and oil prices to happen, because I guess it's down from where it was, the gap price at the pump, but this price per barrel is not moving much like gas is. Bitcoin up today, back over 20,000 per Bitcoin. Nice to see a little bit of a bounce here. I think Bitcoin's looking for support. I would like to see it get above that 21,000 again and restart reconsolidating there. The chart on it's looking real kind of hazy now because the short-term action's been weird, but Bitcoin back up today, getting a little bit of bounce above 20,000. Big data coming out this week. Every Monday I talk about this to let you guys know what's coming. Let me put the peepers on here. Tuesday we're going to get consumer confidence, and the market is expecting it to be up. Go figure. We're going to get earnings on Tuesday as well. A lot of earnings today coming later after the market too. On Wednesday, we're going to get the Chicago Purchasing Managers Index, the Chicago PMI. They're expecting that. It's a big manufacturing index. It's going to be an idea of what's been happening in manufacturing. They're expecting those numbers to be up 1%. We're also going to get on Wednesday, the Mortgage Bankers Index, which they're expecting to be down 3%. That's a pretty big move for mortgage bankers. I think that real estate, it's going to lead this parade down in this recession. Thursday, we're going to get construction spending, which they're expecting to be down. Initial jobless claims, they're expecting that to be lower. We're going to get the ISM Manufacturing Index. We're getting the productivity report. They're expecting that to be down 5%. And the real important one on Thursday, the unit labor cost, which is kind of a measure of what labor is costing businesses, they're expecting that to be up 10.8%. And I promise you, that's the one the Federal Reserve is going to pay attention to as this wage price spiral starts to pick up steam here. On Friday, we'll get non-farm payrolls. They're expecting 325,000 jobs to have been added. We'll get the unemployment rate, which they're expecting to stay unchanged at 3.5%. And we're expecting factory orders on Friday. They're expecting that to be up month over month, 0.3%. So they think businesses are buying, I guess, on those factory orders. I think, this data is going to give us is going to reinforce, I think, what the Fed said about taming inflation. The economy seems to be doing not great, but it certainly is not looking like a crash situation right now. It seems like if people want to work, they can find a job. Might not be the highest paying job, but there is jobs out there. People are apparently still spending money, even though they're borrowing it to do it. It's going to be a very interesting fall and into the holidays this year as we watch how this economy reacts to what I believe is just going to be worse and worse economic news. And other stuff you guys need to know today, very interesting stuff going on. Okay, I was reading this morning that new cars are now costing $48,000 average versus $42,000 last year. That's a pretty big bump for new cars, especially when they're available. I think it's because their availability is so limited, but it's just a big bump. $48,000, we're not talking, high luxury cars here. We're talking the average car. And the average car loan is now averaging, for the first time ever, over $40,000. People are taking out $40,000 loans just to buy a car. That's up over 13% year over year. It's the first time ever, $40,000 loan balances being the norm. And the payments on these loans now are creeping up to almost $700 per month just to have a new car, man. I mean, I guess I'm old enough to remember when that was outrageous for rent. A car payment at $700, in my mind, is just bananas, okay? The Census Bureau came out with a very interesting thing today. They were saying that over the next 2 months, approximately 3.8 million renters will be evicted. This renter crisis now thing is just getting worse and worse. It's following last week's report we talked about on the show of the amount of people that are behind and being threatened with their power to be cut off. Obviously, what follows is if they're having difficulty paying their power bills, and they have looking at $700 car payments, they're obviously having difficulty paying their rents. Not a good scenario, man. 3.8 million renters. That's basically 3.8 million households, guys. Most of those renters don't live alone. Where do they go from there, man? It's not like they're going to go, okay, I'm going to go leave this rent here where I'm paying $2,000 a month and go find a place that's much cheaper. They're just not out there. So this is really bad news. This is the kind of stuff that changes the politics of things. This is the kind of stuff where these populists come in, and it's typically not good for us politically, where you have people can't afford a power bill or to keep a roof over their head or to buy a car, man. It's just stupid. In real estate news, before I click off today, it's a short report today, guys, but I was reading our friends Blackstone. I was talking about their $50 billion real estate fund over the past few weeks. They have paused and are ceasing to purchase houses in 38 cities here in the United States. I guess they're seeing the same thing we've been talking about for months on this show, that prices in real estate are going to correct pretty hard. And that is already starting to take root here, guys. If you saw our show Jordan and I did on Saturday, talks a little bit about the way prices are falling. But listen to this, guys. Places that were the super hot markets are now cutting their prices like crazy and still not getting any sales in. Listen to these numbers, guys. Prices are falling fast. Sellers cutting prices in Boise, Idaho, which was one of the hottest markets. It's over 66% of the people with their houses listed have cut prices. Denver, over 55%. Salt Lake City, over 51%. Tacoma, just under 50%. Grand Rapids, Michigan, really? 49% have cut their prices. Sacramento, 48%. Seattle, 46%. Portland, 45%. Tampa, 44%. And the list goes on and on and on and on. Sellers are understanding the party's over. Real estate prices are coming down. Once you have this type of price cutting going, now it creates a race to the bottom, guys, where a guy's willing to cut his price $10,000. He looks and he sees the guy down the street with the same exact house, model match, has cut his $15,000. What is he going to do? Is he going to leave it at the $10,000 cut and know that the first house getting sold is the one down the street? Or is he going to go to $16,000 or $17,000 or $20,000 cut to now try to undercut that guy? So prices are going to come down in real estate. If you've been sitting on the sidelines waiting to buy a house, you're going to have your opportunity with prices. Now rates are, I can't promise that, because we've been talking about how rates and prices are out of balance, with rates so high and prices high that one or the other has to give. Now prices are starting to give. They're going to continue to come down while rates are elevated, and I think mortgage rates are still going to go higher than they are right now. I think you'll see a rate at 6.5 before this is over, maybe even a little higher, depending on what inflation looks like and how entrenched it is. So prices are going to come down to meet those rates, guys. You're going to have your opportunity if you've been waiting. If you're a first-time buyer that doesn't believe you can get a house, buy a house, start saving your money now, guys. We've been preaching that on this show since day one. Stash 10% of that income. Opportunities are going to be there, not only in real estate, but in stocks, in hard assets. That Mickey Mantle card I was just reading sold for $12 million. I promise you, in 2 years, you're going to get a better, well, maybe not on that particular thing, but prices on assets like that are going to come down like crazy. That Rolex that was selling for $25,000, you're going to get a deal on it if you want one. A couple of years from now, when this recession starts turning into, when the bad part of the cycle, which we're in now, this down cycle ends, and we start back up on the upswing, it's going to look like everything's on sale if you're smart enough to be stashing your money as much as you can. I know it's hard right now, guys. I really do, man. This economy sucks. Prices are crazy. And the worst part about it is, you know, it's not prices on fancy stuff that's going up. It's prices on stuff you use every day, like gasoline and eggs and bread. So I understand it's difficult, but if you can, try to stash as much money as you can. You're going to be glad you did when it's all over. Anyway, guys, we really appreciate your support. If you like what you're hearing on the show, hit that like button. If you haven't already, subscribe to the show. Double check your subscription too. I've been hearing from people that their subscriptions got purged or not getting notifications, so make sure you click subscribe, you ring the bell for your notifications. As always, ask your comments in the comment, or ask your questions in the comment section. And if it's a little more in depth, ask Chuck Barone at gmail.com. We appreciate your support. Until we talk again tomorrow, we'll have a whole bunch more data to talk about tomorrow. See you then. Thanks.